You think you own your house. You don't. You think your 30-year mortgage is a contract between you and the bank. It isn't. There is a silent third party at the table, a party that can destroy your net worth overnight without your permission, the insurance company. For the last 100 years, we've operated on a boring assumption that if you buy a home, you can insure it. That insurance is like water or electricity, a utility, a right. That era is over, dead. We are watching the single biggest destruction of real estate value in history, and it's not coming from a market crash. It's not coming from interest rates. It's coming from a simple letter in your mailbox that says non-renewal. We have entered the age of the uninsurable. This isn't about bad weather. This is about a structural collapse of the safety net that holds the entire housing market together. By the end of this video, you are going to understand why your home insurance is skyrocketing, why millions of properties are effectively going to zero, and the specific due diligence you need to do so you aren't left holding the bag. Let's get to work. Here is why most people are going to lose money on this. They think this is a climate change story. They see a hurricane in Florida or a wildfire in California and think, well, I don't live there, so I'm safe.
Wrong. This is not a weather problem. This is a math problem, and the math has changed. For decades, insurance was a pool. Everyone put a little money in, and when disaster struck, the unlucky few got paid out. It was a guaranteed safety net. Banks loved it. It allowed them to lend you massive amounts of money for 30 years because the risk was transferred to someone else. But that transfer mechanism is breaking. We are seeing a permanent recalibration of value.
In California, State Farm, the biggest insurer, stopped writing new policies. They just walked away. In Florida, the state government is now the biggest insurer because private companies fled. In Australia, by 2030, 1 in 25 homes will be mathematically uninsurable. When a home becomes uninsurable, it becomes unsellable. Think about it. Who buys a house they can't insure? No one. Who lends money on a house they can't insure? No bank. So, if you lose insurance, your buyer pool shrinks by 90%. You are left only with cash buyers, sharks who are looking for a distressed asset. Your home goes from being your biggest asset to a ticking time bomb, a liability that you can't sell and can't protect. And the scary part? You did everything right. You paid your bills, you fixed the roof, but the map shifted under your feet. You need to understand how this is happening so you don't get blindsided. This isn't random. It's a synchronized global withdrawal. I'm going to break down the 3 hidden mechanisms that are driving this crisis right now. Mechanism 1. The Reinsurance Pivot, the casino boss. Most people have never heard of Swiss Re or Munich Re. These are the insurers of insurers. They are the guys in Zurich and Munich who backstop State Farm and Allstate. They are the casino bosses. For years, they only cared about the big one, the massive Category 5 hurricane. But recently, the data changed. They stopped losing money on the big one and started bleeding cash on secondary perils. Hail, thunderstorm, flash flood. These aren't rare events anymore. They happen every week. In 2023, these medium storms caused $64 billion in losses globally. Hail is the silent killer. It shreds roofs and destroys solar panels. So, what did the casino bosses do? They changed the house rules. They raised the attachment point. Basically, they told your local insurance company, we aren't paying until you lose $500 million. Your insurance company is now left holding the bag for all the smaller storms. To survive, they have 2 choices. Triple your premium, drop you completely. They are choosing option 2. Mechanism 2, AI redlining, the spy in the sky. This is the most dystopian part. In the old days, an actuary looked at a zip code. Today, they are looking at pixels. Insurers are using companies like Zesty.ai and Cape Analytics. These companies use satellites and drones to spy on your property in real time. They aren't just looking at the house. They are measuring the distance from a tree branch to your roofline. They are analyzing the granule loss on your shingles. They are spotting moss on your roof that you can't even see from the driveway. If the AI sees a patch of moss, you get a low roof condition score. If your neighbor has a pile of dry wood next to your fence, you get a conflagration risk penalty. This is algorithmic redlining. It allows them to cherry pick. They can insure the house on the left because it has a clean roof and drop the house on the right because of a tree branch. You get a non-renewal notice. You ask why. They say you no longer meet underwriting guidelines. They don't tell you a satellite flagged your driveway slope. You can't argue with an algorithm. Mechanism 3, the mortgage trap, the kill switch. This is how the insurance crisis turns into a banking crash. Every mortgage has a clause. You must have insurance. When you get dropped, the bank gets notified. They don't just say, Oh well, they trigger force-placed insurance. The bank buys a policy for you, but this isn't normal insurance. It costs 3 to 10 times more, and it only covers the bank's money, the structure. It doesn't cover your stuff. So your $2,000 premium suddenly becomes $8,000. That extra $6,000 is added to your monthly mortgage payment. Suddenly, you can't afford the mortgage. You default. The bank forecloses. This is the mortgage trap. It pushes people who can afford their house into bankruptcy solely because of the cost of risk. Don't think this is isolated. Look at Canada. Desjardins Group, a massive lender, just announced they will stop issuing mortgages in certain flood zones. That is the smoking gun. A bank refusing to lend based on a climate map. Insured losses there tripled in 2024. Look at the UK. They have a loophole. The government has a safety net called Flood Re, but it excludes homes built after 2009. If you bought a modern home in a flood zone, you are on your own. You are a mortgage prisoner.
Look at the USA. $1.6 trillion in real estate value is currently uninsured.
That is going bare. People are gambling their entire net worth that the fire won't come. The system is shedding risk everywhere. So what do? You stop acting like a passive consumer and start thinking like a strategist. The era of blind trust is over. You need new due diligence. Here is the system to survive the uninsurable future. Step 1, demand the clue. Report. If you are buying a home in the US, do not just look at the granite countertops. Demand the clue report. This shows the claims history for the last 7 years. If that house has a history of water claims, run. If the previous owner filed 2 claims in 3 years, run. That property is radioactive to insurers. Step 2, check the fire line score. In wildfire zones, don't ask, is it safe? Ask, what is the fire line score? This is the metric, 0-30, that insurers actually use. A score above 3 is dangerous. A score above 4 is a death sentence for your wallet. Use tools like riskfactor.com. If it says 9/10 fire risk, assume your insurance will cost $10,000 a year or be unavailable entirely. Step 3, the insurance contingency. Never make an offer without an insurance contingency, but be specific. Don't just say contingent on getting insurance. Say contingent on securing insurance for less than $3,000 per year. We are seeing deals collapse at the closing table because the buyer finds out the premium is $20,000 a year, which destroys their debt to income ratio. Do not let that be you. Step 4, the plan of last resort. If you already own and you get dropped, don't wait. Apply to the state plan immediately.
Fair plan in California. Citizens in Florida.
Yes, it's expensive. Yes, the coverage is terrible, but it satisfies the bank and stops the force-placed nightmare. Treat it as a lifeboat, not a yacht. Here is the reality check. The world is being repriced. For 50 years, insurance companies subsidized the cost of living in dangerous places. They charged too little for the risk. That subsidy is gone. This uninsurable crisis is actually a valuation correction. The market is trying to tell us that some places are simply too expensive to live in. The insurance industry is just the messenger. You need to stop viewing insurance as a utility bill. You need to view it as a financial derivative attached to your asset. If the derivative is too expensive, the asset is toxic. Don't buy the toxic asset. Don't be the one holding the bag when the music stops. Check your scores. Audit your risk. And understand that in this new economy, nobody is coming to save you. You have to save yourself.